In this video, we'll be talking about the bull call spread option strategy, the pros and cons of it, when to enter, at which strike price, and which expiration date, and most important of all, how to manage your risk, which is when to cut loss and when to take profit. The bull call spread is also known as the debit call spread. Debit because you pay cash from your account to enter the trade. The strategy is best executed when you spot the following setups on the charts. The first one is when you see prices bouncing off moving average supports or trend lines. The best setups will be those that can fulfill the criteria of the momentum swing trading strategy. You can watch this video to learn all about it. Links in the description below. The bull call spread can also be used on stocks that are trading in a consolidation and have reached horizontal support. And lastly, it can also be used to trade stocks that have broken out of consolidation. So what exactly is a bull call spread? How do we structure one? A bull call spread consists of an at-the-money long call and a further out-of-the-money short call. Using Yum China as an example, an at-the-money call would have a strike of about $50, since Yum China is currently trading close to $50. Subsequently, you can sell another call with a higher strike, let's say at 52.5, and that would be somewhere around here. Note that these two legs should have the same expiry. Before we get into the specifics of the strategy, let's talk a bit about the pros and cons. Why should we use the bull call spread instead of other styles of trading, like swing trading the stocks directly instead? Well, options, as we should have been familiar by now, are highly leveraged instruments. As such, an option trade only locks up a little of your capital, allowing you to take on more trades in your account without touching the margin and incurring margin charges. To trade 100 shares of Yum China will take up about 5,000 of your capital at $50 a share. But if you know how to properly utilize options, your required capital to structure a similar trade is often way less than 10% compared to owning the stocks. Because of the lower capital required, the risk as opposed to trading stocks is lower. Say Yum China released bad earnings and gap down to $25 a share overnight. While swinging stocks, you would have lost 2,500 of your capital overnight. What about options? At most, you lose all of your capital that is used to take up the trade. But that is still way less than the 2.5 grand that you would have suffered if you were to swing trade the stocks. But low risk, low reward, right? But no. If you do your risk management properly, the reward while trading options can be kept at a similar level as compared to trading stocks as well. The only bad thing about options trading is that time is against you, as your option contract has an expiry date. Upon expiry, there is a chance that your options may expire worthless. But worry not, we will be discussing how to overcome this in the strategy breakdown later on. Let's get a little bit more technical. Why not just buy a long call then? Why the trouble of selling another call at a higher strike? In short, most of the time it is not worth it and relatively expensive. Why? When you long a call, you are long theta and exposed to time decay, where your option loses value for every day that passes. You are also long vega, and if implied volatility drops, your option loses value as well. Next, if you recall the risk profile of a long call, you would have known that this strategy gives you unlimited profit as long as the stock keeps going up before your expiration day. But for the bull call spread, because you sold another call with a higher strike, you are essentially capping the profit of the trade. Then isn't it dumb to take on the bull call spread? Well, actually no. If you think about it, unlimited profit does sound attractive. But then again, how often do you get to realize such huge profits? How likely is it that Yum China will go from, let's say, $50 to $100 within your expiration date for you to get that rich profit? Since the probability isn't that high, why not set a realistic cap by selling a higher strike call, collect some premium and use it to offset the cost of your trade? That's the reason why a single long call is relatively more expensive, because you're paying for the dream of having unlimited profit. And after explaining so much, if you still choose to stick with trading single calls or puts, then please at least exit the trade with more than 30 days to expiry to reduce loss from time decay. Alright, with that, let's get into the specifics of a bull call spread. As mentioned, a bull call spread constitutes a long at the money call and a short further out of the money call. Using the Yum China example previously, buying a call at a $50 strike that is expiring on the 17th of July will cost us $1.10. At the same time, selling a further out of the money call at the strike of 52.5 will allow us to collect a premium of 0.275 cents per contract. With that, our premium paid for this trade will be 0.825 cents, and our cost of trade multiplied by 100 shares will be $82.50. If we look at the risk profile at expiration, our max loss will naturally be our cost of the trade, which is $82.50. And this occurs at our long strike by the time of expiration. So if Yum China stays at $50 or worse drop lower by 17 July, then we would have suffered the max loss. Our break even for the trade is basically the long strike plus the premium paid. So our long strike is $50 and our premium paid is 0.825. That gives us a break even price of 50.825. Lastly, our max profit at expiration will be the difference between our short strike and the long strike minus the premium paid. And this gives us 1.675. Remember to multiply by 100 shares, and therefore our max profit is at 167.5. Our max profit will occur at our short strike, which is $52.50. And this will only occur on expiration, which is the 17th July, if Yum China stays at 52.5 or goes higher than that. Alright, so therefore choosing the correct strikes and expiration is very important, especially our short strike, as it determines your max profit and whether you will get to keep them all at expiration. So how do we select our strike prices? You can think of the strike for the at the money call as the entry price for the trade. And the strike of your short call will be your profit target. So naturally, we will need to know what our profit target is in order to set up this trade. There are a few ways to do this. First, you can calculate your profit target just as if you are going to swing trade the stocks. Set a suitable stop loss, get the distance from your entry point to stop loss as your 1 unit of risk, and then double that distance to arrive at your profit target. For this, watch part 3 of the momentum swing trading video to learn more about this method. The second way is through the Fibonacci extension levels. Identify your start and end of the impulsive and corrective wave and take the 100% level as your profit target. When I conducted this trade, I used the second method, and the 100% Fibonacci extension level is somewhere at the $53 mark. But when I look at the option chain, there is no 53 level. There is only 50, 52.5, and then 55. So what do we do next? To be conservative, I can choose the strike that is below my target, and in this case, it will be the 52.5 strike. With that comes lower cost of trade, lower max profit, but higher probability of realizing it. Or I can also be aggressive and choose the higher strike that is above my profit target, and in this case, it will be $55. Pay more for the trade and get a higher max profit. But the stock may not reach this higher price by expiry if the momentum is not strong enough. Alright, so this is some of the tips that you can consider while selecting your strike prices. Next, let's move on to the second step, and that is to select our expiry. The maximum date to expiration would be somewhere around 30 days. I'm sure that all of us want quick trades and do not want to be stuck in one trade for too long, right? There is another way that I use to optimize the selection of the expiration date. But this would rely a bit on your experience and personal judgment. If the historical price action of the stock is beautiful, meaning to say that we can identify the impulsive and corrective wave very easily, like the chart over here, then what I will do is to count the number of days taken for each impulsive wave and then add on another 7 days as buffer. So for example, we can see that this impulsive wave over here takes 1, 2, 3 days. And then subsequently another one that took 1, 2, 3, 4, 5, 6. And 1, 2, 3, 4, 5, 6, 7. The last impulsive wave took about 1, 2, 3, and 4 days. Right, so on average, each impulsive wave took about a week to complete. So that's why although the option chain doesn't have a 30 days to expiration, the nearest one being only 15 and the next one is 50, I can still accept the 15 days one based on the price action of the stock itself. The minimum days to expiration that I will trade is 7, but in fact I wouldn't even recommend it at all, as it is usually too fast, leaving little room for error. After you have selected your strikes and expiry, you have basically structured your trade. The next step is risk management, and this is very important. The key to becoming a successful trader is to be consistent. Fix your max loss for all your trade to be a certain percentage of your capital. Following this, your max loss for the bull call spread must not exceed this amount. For example, if the size of your account is $10,000 and you risk 1% per trade, this means that for each trade, you can only lose a maximum of $100. In that case, you can trade one contract of Yum China bull call spread without problem, since each contract only have a max loss of $82.50. But if you risk 2% per trade on the same account size, then your max loss would now be $200 per trade. In this case, you can take up to 2 contracts of the Yum China bull call spread. You get the idea. And I would not recommend going beyond 2% risk per trade. So using the same capital size of $10,000 and risking 2% per trade, what if the max loss for the trade is more than 2% of capital? Let's take a look at a live example. Alright, this is the daily chart for Microsoft. And let's say that Microsoft were to break out of this resistance over here at $215, go all the way up. Let's say you think that it will go up to maybe $230. So how can we structure our bull call spread in this case? Now take note that this is just a random example that I'm giving. I'm not saying that this is an ideal trading setup. Alright, so with that, let's go over to the option chain. And let's say we choose 30 days to expiration. And that will be for September 2020. With 28 days to expiration, that is the closest to 30. Expand that. And what we want to do will be to buy at the money call. So that can either be the 215 or 217.5 strike. So let's say we stick with the 217.5. Just click on buy. Next, we want to sell a higher strike at 230 because we think that Microsoft will reach 230 or even higher by a month's time. Alright, so now you see that our cost of this trade is now $4.09 per contract. Multiplied by 100 shares, that will be 409. And that is clearly way more than the $200 that we are willing to lose per trade. So what do we do then? Don't panic yet. Still go ahead to analyze your risk profile. So right click and analyze trade. And that will bring you to this page. So first of all, what you want to ensure is that this date over here is set at the day of expiration for the contract. And that will be 4th September. So on this chart over here, what you are seeing, the y-axis over here, this is your profit and loss. The 0 mark is over here. Obviously, everything that's above the 0 is your profit. Everything below is your loss. The x-axis over here is the prices for the underlying stock. Alright, so you can see 2 lines on the chart. This red line you should all be familiar by now. This is our P&L by expiration. What's new is this purple line over here that I'll be highlighting in black. This line tells you your profit and loss at the current moment, and that is set to this date over here. On the 7th of August, this is what your profit and loss will look like if, let's say, Microsoft were to go to 230. You can focus on the number over here for your P&L on the date itself, and you can focus on the red number over here for your P&L at expiration. So when I mouse over at $230, on the 7th of August, you would have made $344. And what you will notice is that as I scroll through the day, meaning to say that as we get closer and closer to expiry, what do you notice happens to the chart? You can see that the purple line gets closer to our P&L by expiration. The 2 lines are converging, and on the expiration date, your P&L becomes the red line itself. Alright, so even though the max loss for this trade is 409, that is bigger than our $200 per trade that we are willing to risk, I will still go ahead and analyze this trade. What I'll do, first and foremost, is to locate the price level of Microsoft where I'll lose $200. Alright, so on this risk profile, I'll lose about $200 in this trade if Microsoft were to drop to 204 on the 7th of August, which is the day that we are going to enter our trade. And this also means that when Microsoft drops to 204, we will have to get out of this trade because by then we would have suffered a max loss of 2% of our capital. So importantly, what I want to do is to go over to the charts and find out where this 204 level is on the chart. So 204 is somewhere here. What I want to make sure is that this level where I would have suffered my max loss is at least behind some level of support. And in this case, you can see that 204 is behind the 20 exponential moving average in red dotted line. So in a sense, our stop loss level is behind a support. Therefore, you can go ahead and place this trade if you believe in the 20 EMA being a strong support. If you want to be more conservative, you may think that the 20 EMA may be too weak of a support. You want to rely on the 50 SMA as the support instead. And if that's so, then this trade would be invalid for you because your max loss level will be above your intended support. That will be considered risky according to your risk appetite. Okay, back to the risk profile chart. It is also a good practice to look at your profit and loss when we are halfway to expiration. In this case, our days to expiration is 28 days. I want to check my profit and loss somewhere about 15 days to expiration. That will be perhaps somewhere on the 21st of August. So what I want to look out for is at which price level corresponds to my max loss for the trade. By the 21st of August, if Microsoft still stays at 209 or below, I will have suffered a max loss of $200, which is 2% of our capital of $10,000. Lastly, always ensure that you are in a favorable trade. That is, the trade will earn you more than what you have risked. Minimally aim for a risk to reward of 1:1.5. Though personally, I will always go for 1:2. And if you look at our Yum China example over here, we are risking 82.5 to make 167.5. And that is clearly somewhere about 1:2. If we go back to our Microsoft trade example, you can see that our max loss is 409. Our max profit is 841. Right, so 409 to 841, that is also about 1:2, and in fact slightly more than that. Once all these are fulfilled, you are free to go ahead and place your trade. The next thing that we want to focus on is the exit strategy. Do we always wait to expiration? This is another section that largely relies on your experience and personal judgment. The most clear-cut rule is to exit the trade when the profit has reached 90% of your max profit. Quickly get out, as there is no point risking the remaining time for the last 10%. But more often than not, it's not so clear-cut. Let's say that the stock price has reached your target and you still have time left. You can let this trade run if you set a conservative price target back then, or consider closing the trade for a profit if your target is aggressive and stretched far away. When there is less than 7 days and you have not reached 90% of your max profit yet, what you can do is to monitor for signs of reversal and exit when there is a signal to secure most profit. For example, over here, you can see that these 3 candles already form a reversal signal. So you can use it to close the trade and get out with whatever profit that is left before the next corrective wave starts. Next, what if prices are stuck in between and there is no time left? Then you could choose to close the trade early with whatever little profit or loss if you don't see possibility in the price action anymore. Otherwise, you can choose to wait it out, but if it doesn't work out, then it's most likely max loss for the trade. What about the exit strategy for cutting loss? For this, you must exit when your loss has reached 2% of your capital. Alternatively, you may also choose to cut your loss and exit early if you see bearish price action, such as stock prices breaking below support and perhaps give a 1 ATR buffer range below the support. You can also choose to close it prematurely if stock prices break below the previous low and form a lower low, meaning to say that the stock is no longer in an uptrend. And lastly, you can also close the trade early for a loss if a downtrend signal starts to show. For example, the 20 EMA crosses below the 40 EMA. This would have been a signal for a short-term downtrend. In summary, this is what we have just went through. To understand how this strategy is executed real time, and to understand more about the analysis and decisions involved in trading this strategy, watch my live trading example on Yum China. Links in the description below. Do this video and the channel a favor by smashing the like button and subscribe to the channel. If you still have any unanswered questions, do also drop them in the comments below. Feel free to join our Telegram community group for more active discussion and sharing of trade and investing ideas among members. I'll see you in the next video.